Hello and welcome to Heartrepreneur TV. I'm your co-host Velma Gallant, and I'm super happy to have you here. We have a very interesting show for you today. What is the ultimate goal of a comprehensive tax strategy? So we have Eric Levenhagen. I have to really think about it to get it right. Eric is the founder of ProWise Financial Consulting and is a business financial consultant who assists professional service providers across the country with profitable, strategic tax advice and business growth using a comprehensive system called Financial Harmony. He has more than 20 years of business experience, encompassing work with more than 300 business owners and entrepreneurs in a variety of professional services industries. He is passionate about helping business owners build a business that supports their life. Welcome to the show, Eric.
Thanks for having me, Velma.
So, the ultimate goal of a comprehensive tax strategy. What is the ultimate goal of our tax strategy?
Well, it's important. I'll tell you that. So usually when I'm talking to people and I tell them that one of the three major components of what we do is a comprehensive tax strategy, most people go right to thinking that, and very rightly so. But generally people think we're going to save money on taxes. And the distinction that I make with this whole piece is that, yes, that will happen. And that's actually, though, a byproduct of what happens through the tax strategy process. So you are going to save money on your taxes with a well thought out plan. But the actual strategy, the actual goal that we're going after here is to increase your after-tax wealth. And there's a small but subtle distinction there, because you might think, well, gee whiz, Eric, if we reduce taxes, that's going to give me more after-tax dollars in my pocket. Won't that do the same thing? Yeah, it can, and it does, except the reason I make the distinction about it is because we have different types of tax professionals out there, and the focus that tax professional brings to the table for you can have a big difference on the results that you're going to get. And, quite simply put, like the wrong focus coming into the strategy piece of any engagement is going to usually generate some bad or non-optimal advice for folks, right?
Okay. So what I think I heard, and this is me kind of making it up, is if we focus just on reducing taxes, we might be missing out on other ways of increasing the after-tax wealth. That we're getting distracted by one part of your strategy.
It could be. So that's one good example. Yeah. Is that, so a lot of times, so the example there is a lot of times folks will come to me and, taxes and money, like everybody deals with them. And so everybody has an opinion about how to handle it. Right. So, and so a lot of times folks will come in and, and I'm all about people bringing, their own questions and ideas to the table. It needs to be a back and forth exchange between me and a client. Right. But when they come in, they may have they read an article somewhere, or they got told something from, their bartender's neighbor's daughter's, niece or whatever, down the line that you can think of, that, they bring a question up, or, they hear about something and they think, oh gosh, that could save me money on taxes. I really want to do that. And the point that we make is, yeah, that's possible. But is that the best move for you? Not all the tax code is what it is, right? Mm-hmm. We're all working from the same set of rules. But it's how you think about those and apply them in a case-by-case situation. I mean, even though so much of the tax code is, and not the code itself, but the strategies that we employ are facts and circumstances based. So when we talk about tax planning cases, right? I always say, when I've done one, I've seen one, which means, just because your neighbor did it or a colleague that's maybe in the same industry and the same revenue level you are in business, just because they did something doesn't mean that that's ultimately the right and best move for you. Does that make an okay sense? So
It does. I like what Virginia said here. The only things certain are death and taxes. That's good. Okay.
with a good plan,
So
it doesn't have to be certainly high taxes. So there you go.
well, and that's I think what we're all hoping for. Okay, so what I'm hearing is that your strategies that you bring to the table for each of your clients is very individual to them, because even though they could be in the same industry, could be in the same income bracket, they're looking at them holistically, they will never be identical.
Right. Yeah. Because a lot of times, I mean, you're right. There is a small subset. We've got about 10 core strategies that we think every business owner should be looking at and considering, no matter if they're big, small, in between. Those, and not everybody's going to use all 10 of those, but the right mix of those are going to at least potentially apply to almost everybody. Okay.
Mhm.
Once you get beyond that, there's only 10, there's 10 good ideas, but there's 10 tactics there. Once you get beyond that, we get more into advanced strategies. And what I always say is advanced strategies are, they really have to be tied into your personal goals. So for instance, I'll give you a real life example, which is retirement plans, right?
Mhm.
And so, we'll go into the whole hierarchy of retirement plans, but a lot of tax pros like to bring up the 401k. The common thing we hear, somebody new comes in the door, hey, I'm maxing out my 401k. So we already do that. I go, great. Are you maxing it out? And I forget the actual like inflation adjusted numbers. They're easily Googleable, but so the numbers, don't quote me exactly on these, but I mean, I say, great. Are you maxing out? How much are you putting in? And they'll say, well, like 19.5 or $20,000. And so, 401ks can actually go up to, again, what is the number this year? 57 or 58,000. So the point there is, if a tax professional comes in, a planner, and gives that advice to say, hey, you're only putting in 20, you can get up to almost 60. That's almost a $40,000 difference. Number one is, well, A, do you have the cash flow to do that? But secondary is, like, what are you trying to do with the money that you're generating in your business? Do you want to invest more in those kinds of assets? Do you need more qualified money in your retirement plan that's pre-tax and is going to probably be taxable, or it will, if you're getting the deduction, it will be taxable when you pull it out in retirement? Or is there something else we can do? Or do you want to invest it somewhere else? Do you want to start an endowment? What are your, what other life goals do you want to check off that we can use that money for? So we just don't want the focus when we get to the advanced stages to be narrow, right? And just
Right.
using the pieces of the tax code because they're there. Smaller example, I guess, would be where people get into, typically, and we can talk about this a little bit in a bit, perhaps, about, 3 different types of tax pros, but typically what we see is that, the majority of tax professionals are not extremely proactive. And the objective mark for that, because usually I get, well, Eric, how do you tell how good of a job my tax person is doing? Because we're not tax experts, all of you. So you really have, no great way of knowing, perhaps. And so, and usually I get like the same story. I think I hear it every day when I'm talking to potential new clients. My tax person's really nice. They file our stuff on time. We've worked with them for years. Half the time they were my dad's firm, or, my uncle's firm, and he was, whatever. Or they're the hometown hero kind of CPA person. And they're reasonably responsive. Like, if I reach out with questions, they typically answer them. And so that's great. And it may seem like things are going really well. The objective marker for you is quite simply, how often does that tax professional come to you with ideas to save you money? Because if you think about it, you can come to them and ask them questions, all the time. And again, we want that, except for you probably don't always know the right questions to ask or the right opportunities that are presenting themselves that you wouldn't see that perhaps a seasoned tax strategist would see, right?
Okay, and it's making a lot of sense to me, because I like that you talk about how the advanced strategies are connected to your personal goals, and that you've got the 10 core strategies. And so what I think I'm hearing is, um, the majority of tax professionals probably have a great understanding of those 10 core strategies, and um and you see them at tax time, and they take good care of you, they give you good customer service. But what I'm hearing is you go the extra mile of finding out what their personal goals are. And I doubt this is the same, but it's something that popped up for me while you were chatting is, depending on my goals, how I plan on living my life in retirement. I mean, here in Canada, we have the registered retirement savings plans, but we also have a tax-free savings plan. And all that means I pay taxes on the money before the money goes in there, but whatever grows in there, I don't pay taxes on. Whereas RSPs, I don't pay taxes on that money when it goes in there. I pay taxes on that money when it comes out. So depending on what my goals and strategies are, what my goals are, how I plan on living, it might be wiser for me to invest in one particular thing versus another, depending on that. So that's kind of what I'm hearing in my not experienced arena.
Yeah. Well, and I'll say too, I'm no expert in Canadian taxes, but that sounds like very much so the same thing that we have down here between traditional and Roth accounts, right? As far as the retirement plans go, they work the same way. Get a deduction when you put the money in, pay taxes on all of it when you pull it out, or the Roth, which is, just like what you said, you don't get a deduction up front, but whatever grows in there until you pull it out is tax free at the end. So yeah, so the retirement plan continues to be a good example, but even then, I mean, retirement plans, they're good when they're set up well and they're well positioned and they work in your personal financial planning picture. But retirement plans, like I said, a lot of people think they can go up to almost 20 or around 20,000. 401ks can actually go up to 58. There's another level of plans that can be a couple hundred, more than $200,000 worth of deductions. But all of that is similar in the fact that, again, if you're increasing your contributions in order to get the tax deduction, which is kind of what we're talking about here, and let's say we've maxed out the Roth, or we've done as much of the Roth, the after-tax money that we want, is still in those pre-tax accounts, is still locked up, right? Until in the US, it's still you're 59 and a half years old, then you can start pulling it out without penalty. If you pull it out before then, you're going to be penalized. So a lot of folks in their life goals are like, well, and a lot of my clients are working towards building a business that they can sell at some point. So we've got that penciled in as part of their retirement structure. They might, they own real estate. A lot of them want to keep the funds liquid for other uses besides just popping it into a retirement plan and locking it away until they retire, right? So we use all or as much of those different pieces as we can that makes sense for that particular person. So that's all we're really talking about there. It goes,
okay. That makes a lot of sense, because what I'm hearing is that you're not just doing, the tax strategies so far as being able to do their retirement and everything like that, but is the way you want to live your life right now, does that fit into that quote unquote retirement plan, or does your retirement plan fit into the way you want to live now?
Yeah, right. Well, and because we can have other sources of, you can have other sources of retirement income besides the 401k or the traditional retirement plan. And And a lot of folks get, not to go too far down the rabbit hole on retirement plans, but some folks get antsy with investments in the stock market. They just aren't completely settled with the options that a traditional plan gives them. They want to go out and invest in real estate, businesses, alternative investments, other partnerships, those types of things. And so the idea there, and the idea with all advanced tactics, right? Because we can talk, it would take a full day, but we would talk about a variety of advanced tax topics. Some would be retirement plan and or maybe life insurance product based. Others would be, multi-entity structuring and different ways to legally shelter income. I know people get kind of antsy when I use the word shelter, but legal, like domestic shelters, not the bad kind. But with any of those advanced tactics, right, you have the amount of money that you're looking to live on, looking to fund your lifestyle today, now, and within the next handful of years. So we want that coming out of the business. We want that to be tax efficient. So, make up a number, whatever you want that to be. Let's say it's $100,000, right? So we make sure that's as tax efficient as it can be so that it remains liquid and you pay your bills, a few thrills, go on your vacations, do all that stuff. And then what are you going to do with the rest of if your business is generating more than that? What are you going to do? Most people will either leave it in the business or pull it out and put it into another savings account. They're just going to get taxed on it and let it sit there until an opportunity comes along where they want to invest in like some of those alternative investments, or until they build up enough where they can start, an endowment fund or whatever they want to do, right? Or buy a second home, or whatever it is. And so it's, how do we protect those dollars, those additional dollars in the advanced stage from taxes, while you're kind of in a self-accumulation phase, but it's not necessarily for retirement. It's for what else you want to do with your money during your lifetime.
Mm-hmm. That makes a lot of sense. And it really is comprehensive or holistic. It's encompassing the whole of your life now, what you plan on building and what you plan on retiring with. So it's like the whole of your life.
Yeah, exactly. And it needs to be, because in order, most tax professionals will, and I've said this for years, right? Like the financial services industry, especially for small business owners, it's broken, because it's really built for employed people who don't have as many moving parts. The traditional kind of system that we chug people through, which is, we make the money. So in the business world, you have like the bookkeeper who, and the accountant who kind of wraps up your financials, and they hand that off to the tax person who puts numbers into forms and files them by the right deadlines. And then you hand off whatever money is left over to your financial advisor, and they advise you on, personal investments and personal financial planning and all that stuff. And they all kind of most of them work in their own silos, and they're just kind of taking the handoffs from one person to the next. And there's no real connection there, right? But all of that, for you to get, especially as a business owner, for you to get what you want, and get your money positioned to where you want to have the most impact during your life and make the most contribution, it does take a very connected, it's all interconnected, right?
Mm-hmm.
From the moment a dollar comes in the front door to your business as top line revenue, all the way until that dollar can be positioned to fund your retirement, to fund your legacy, whatever you want to do with it, until it's positioned for you to generate after-tax wealth. Everything in between there needs to be a well-connected and well-oiled machine to allow all the different pieces to work together to get the best result.
Okay, that again makes a lot of sense. It's the in your financial body, you have to have the head talking with the arms, talking with the legs, in order for them to all operate well together.
Exactly. Okay. Yeah, the hip bone is connected to the leg bone, and and it's the same with in the financial world with your money, for sure.
That is awesome. Okay, you mentioned earlier something about 3 categories of tax professionals. Let's touch on that.
Sure. Yeah. So this is something I just observed over a lot of years in the industry. I mean, been in the accounting world for over 20 years and been in practice for, what is it by now, 12 or going on 12. And so what I've observed over that time is that, and this is how to get people to conceptualize some things that we're talking about here, the different approaches that people can take or bring to the table for you, rather, with tax professionals. So let's start with the ones that, again, are the majority of the industry, especially, I think of them as the solo, usually they're solo CPA office. Maybe they have a partner, but it's one or two people. It's a small staff. Um, and they are normally, we call them the tax preparers. They're important, and it's an important thing that needs to get done. However, their business model is they focus a lot on compliance work, on tax preparation. And so when, if you have one of those where you can't get a hold of them, especially during this time of year, filing season, tax filing season. So if you can't get through to them very much from January through April, and they're not bringing you consistent ideas throughout the year to save money, you likely have a tax preparer, right? Usually it's the smallest firms, but they can exist anywhere, kind of in the what you think of as a CPA firm hierarchy or structures. Mm-hmm. So look, like I said, we need tax preparers. It's not like they're doing anything wrong per se. It just depends on where their focus is at, right?
Right.
They're probably doing the job that you hired them for, and they're doing it well. But the misconception is that they're also looking out for you in all areas to minimize your tax bill, and that's just usually not the case. So that's the first one, is tax preparer. Then we go up the ladder to tax planner, and I added this one. I used to only have two, but I added this one several years ago, again, because most of the bigger CPA firms, or what we call the full service CPA firms, will list in a huge menu of stuff that they do on their website. They list tax planning as one of the things they do. And what that, again, there's always exceptions to the rule, but what we found generally that relates to is that you may talk to them a couple times during the year. You may get a tax projection if you're lucky. If they're doing more than most halfway through the year, and then again, or usually the only one you get is around the end of the year, like fourth quarter. Mm-hmm. And then they project out how much tax you're going to owe based off what's happened for that year, and then they show it to you, and then they leave you to try and figure out a plan to pay for it. That's the planning is mostly the projection, right? So that's that's a component. It's like double checking things at the end of the year for us and throughout the year. But really, we need more than that. We need to start that process, that planning process, sooner. Because what happens in the fourth quarter when you're sitting there in October, November, and somebody, the tax person comes in and puts a projection in front of you, and you're like, you've been working all year long to grow your business, to improve things. You've probably grown top line revenue. You may have more taxable income, and whoops, now it seems unharmonious, because now it's like, oh, now I don't want to have made so much money because I can't really pay this tax bill, right? Or I don't want to pay this tax bill. It seems outrageous. So then if you ask for advice at that point in time, typically, a tax planner will jump into action, but again, it's usually that's a reaction, right? That's reactive advice.
Yeah.
Because you see the bill first, and then you're like, oh, no way. And then they're like, okay, well, here's what we can do. And it's going to be, again, some things that may make sense, but, I've seen the most common one, well, I don't know about the most, but the one that I always chuckle at, because I've always wanted to know, I don't know if that's even possible, but I've always wanted to know if there's a study that can be done on the auto industry, especially here in the U.S. I'm not sure about Canadian tax rules, but here in the U.S., a study that can be done on the impact of the tax profession on the auto industry, because it seems like I untrained people for years to come in November and ask if they should buy a 6,000-pound truck or SUV, right? It's like they were using that solely for the tax deduction, because that 6,000 pounds is the magic number that they can write it all off in 1 year, right? But whether it's vehicles, it's the typical end of year strategy or end of year tactics that all have their time and place, but for different reasons, and not really good. They're not really good to make the cornerstone of your tax planning, right? It's buying a vehicle, buying equipment. A lot of times you're going into they're going into some sort of debt. So they're increasing their debt load to save maybe 40 cents on the dollar on their tax bill so they can write this stuff off. Prepaying expenses is and deferring income is another one that can really wreak havoc with people. But it's, again, a common tactic that we use. And again, I'm not saying I've never used or advised somebody to do these things, except for it's kind of like a backup or a last ditch effort at the end when we've already been talking all the way throughout the year and before, and we're now to the end of the year and we had a surprise, right? We've talked to them every month or every quarter, and somebody came in October, and all of a sudden we're up 20 more % than what we thought we were going to be. Awesome.
Well,
how do we?
It makes sense, because that's like you set up a goal at the beginning of the year with your doctor to lose 20 pounds.
Mm-hmm.
And you wait until the end of the year to go see him, and have you or have you not reached your goal, instead of going to see him, every month, every quarter or something like that, to check in and see, do we need to make an adjustment to your diet? Do we need to make an adjustment to your exercise? It's like that whole time in between, you can't make any adjustments at all. You can't make any kind of new decisions.
Right. Yeah. Yeah, exactly. Right. If you're not checking in and tracking the progress and making adjustments throughout the year, then you are going to get stuck potentially at the end of the year with a surprise, for sure.
So we have one of our listeners who's asked a question and wants to know if you work with small businesses.
Yeah, we work solely with small businesses. So. Look, the distinction about me is I am a CPA. I do have an accounting background. Today, I run a financial consulting firm. So it's a financial advisory service run by a guy that has a CPA background, that knows all these ins and outs of, well, today we're talking about taxes, but business growth, profitability, and taxes. And we start talking about personal finances as well, right? So everybody comes into that kind of comprehensive approach. We stopped doing the one-off work because it just wasn't serving people in the best way that we could, right? So it just the results just weren't as good. They just didn't work out. So yeah, to answer the question though, it is only small business owners, and I think we have a follow-up question.
Yes, we do. Do you do taxes too, or do your clients keep their tax preparers?
Yeah, it's funny when the Obamacare first came out here in the U.S. I always said, if you like your tax preparer, you can keep your tax preparer, but because that was the whole Obama line with the doctors, but. Almost all, I think, very high, probably 99% of our clients will bring their tax preparation work to us. So we have a team that does do the taxes. I oversee all of that. And so, so we can make sure that the tax strategy that's put into place throughout the year for you is being reported at the end of the year or at this time of year properly, right? Mm-hmm. So, and there's also, some CPAs have issues with signing off on somebody else's strategy work. So it usually makes sense. That's why we have such a high percentage of folks that bring their tax preparation work to us, not because we're pushing for it. That's a huge revenue center for us, but it's a service we can provide to make it, well-rounded and make sure that you're getting the savings that we're talking about all year long.
That makes sense. That makes a lot of sense. So we are pretty much at the end of our time. Do you have any closing thoughts that you'd like to share with our listeners?
I think, real quick, the only, I talked about 2 out of the 3 tax pros. The third one is a tax strategist, which it's what I've been talking about this whole time. That's what I am. And so if you want a more comprehensive approach to your tax planning that works well with, your life goals, your business goals, and connects it all together, you should really be in search of a tax strategist, somebody who's going to take a comprehensive approach to your personal situation.
Perfect. Thanks, Lisa, for your comments. She is very interested in learning more and would love to get your contact information. And of course, you are with ProWise Financial is your organization. What would be the best way for somebody to contact you? What is your website?
Yeah, so you can go to our website. It's prowise.financial.com. And there's actually, if you want to learn about the 10 core tax strategies that we teach, I have a link I can share for that. It's prowisefinancial.com/12 and the letter K, 12K. And the reason why we say that is because that's on average when an established client comes in and implements as much of that as they can, that's their average savings is $12,000 per year. So prowisefinancial.com/12K. Empty sign up there. There's options to schedule a call with me on the website as well, but there's an option to in that guide as well, in that free download, to set up a call there as well if you want to learn some more.
Awesome. So thank you so much for your time, Eric. There was a lot of really great information in here. I love that it is the holistic, the whole financial body that you're looking at. It's not just the tax strategies. And for those of you who have been watching us on Heartrepreneur TV in the Facebook group, we appreciate you. For those of you who are going to be watching this on YouTube, please come on over to Facebook, find Heartrepreneurs with Terry Levine, and we would love to have you inside of our group and hanging out with more heart-based business owners like Eric and myself and Terry Levine. You will be able to find Eric inside of the Facebook group as well. So thank you so much for coming out, Eric.
Thanks for having me. It's been great.
And thank you to our listeners for visiting with us. And I hope you found value. And we would love to hear what it is that you got of value from today's show. Have a fantastic day.